Hello, welcome to day 7 of my trading journal to help me learn ICT concepts in a demo environment in preparation for live trading. So just to follow on from the previous session, we were looking at daily bias. This is on a daily chart here. We identified this level that we're expecting price to go to in theory, and that's going to give us a bullish daily bias. And all that means is just basically, when looking for whether to go into buy positions or sell positions, I'm going to be primarily looking for buy conditions. And I was thinking about how strict I should be with the bias. If we establish that our conditions for a daily bias has been met, I'm thinking that I'm just going to go for long trades, and I'm just going to trade with the bias rather than trying to force trades. So if we jump down into the lower time frame, and we're just going to go forward until we get to Tuesday. So that's the midnight open, that's the London session, and I'm going to be looking for trades between 8:30 and 11. We've kind of gone forward a little bit too much there. Okay, right, so let's do what we usually do, which is to try and confirm this bias. So we're going to be looking at the PM session lows and also the London session lows. And then I guess we can also look at the London session highs as well, and also the PM session highs. And so both of these levels have actually been traded into. So what we want to do is just ask which one of these levels was traded into first, which would have been the buy side liquidity of the London sessions. That's the first level that price went to, which is kind of significant when looking for this three pattern structure of accumulation, manipulation, and then distribution. So I'm going to assume that we're on the distribution phase of price movement and start looking for long positions. So we can already tick off our buy side liquidity being taken here, and if we create lows and then equal lows again and then price comes down there, I'll consider that buy side liquidity being taken again. So let's mark up some of this. So that's the first one. Then we want a market structure shift. I've added in brackets energetic move above a swing high. So the question would be, is this leg in price action an energetic move above a swing high? And yeah, I would say we've got a price one above a swing high here, so that's a market structure shift. It's also gone above here as well, so we had our market structure shift here. Then we're looking for a fair value gap and also an order block or a breaker. And I was going through the 22 mentorship again, and actually for the ICT model, the order block isn't strictly required. I've sort of just added extra confluences here. But after on rewatching it a few times, ICT does mention that the ideally we want to see a fair value gap within an order block, but that doesn't necessarily validate the whole trade. So if we were thinking of order blocks, we've got significant low being broken here, we've got bearish candles prior to a rally that creates a fair value gap, breaks above the high that led into the low being broken here, which is a change in the state of delivery. So, I mean, it's a little bit confusing. We could say that maybe this is the order block. Got a significant low broken, so we've also got the last down close candle before a rally. But it's a bit confusing though, because what if price comes up here? Is this going to be the rally, and then are we going to be looking at potentially this here? I mean, this already looks like an order block. The way I try and help myself to identify it is if we see price coming back to this same level here, that is pretty typical of what an order block acts as support. As price comes through this swing high here, it comes back down 1, 2, 3 times there, forming a pretty equal level. So this to me looks more like the order block, and the reason the order block's so confusing is because, I mean, that kind of could be the order block. If it was just the last down close candle before the whole rally, that could be it there. So that's because the order block's a little bit open to interpretation, at least for now, while I'm still learning this stuff. So I'm just going to do my best and just mark this as an order block. And then we want to see fair value gaps. And we've got fair value gap here. We've also got a fair value gap here as well. Although it looks like if price was going to come down into this fair value gap, it would have done it here. So this is already starting to get a little bit muddy in terms of, you know, which fair value gap to use. So then we'll try. It also says an inversion fair value gap is valid as well. So we could be looking at this here as a potential inversion fair value gap. If price closes above there, then comes back into it. Next, the entry would have to be within a discount, and that would be from the most recent low, which, as of where we are right now, it's kind of like this is the most recent low. This is the previous market structure shift, but it also kind of looks like price is about to make another low here, so we might actually be anticipating something like this. And if that's the case, it doesn't really look like price is going to come below the, because that's our fifth requirement. Ideally we want something where, you know, price came down, comes back up, creates a market structure shift high, then comes back down into below the New York midnight open. So already I'm kind of, yeah, just confused here, not really sure what to do. And the my biggest downfall in the past would be just taking a trade anyway, even when I'm not sure. So we could go through a few more candles. Let's just see what happens during the morning session. So we're not really going to be able to use any of these fair value gaps here, are we? Because I think at this point, if in order for this fifth condition, price below the New York open, to be met, price would have to come all the way down here and like kind of break structure to the downside, which would be this type of stuff we'd be looking at to invalidate the trade. So we have to keep using the most recent low, don't we? So this doesn't really look like it's going to work for us. It's just the fact that I'm trying to have to rationalize it and, you know, ask so many questions, it's just, this is the type of trade that we just want to avoid. Since I can't use this midnight open as an entry requirement, I'm actually going to go back to my other strategy, look at that again, because this one actually omits the requirement of coming down to the midnight. And this is sort of, you know, I look at this, this whole strategy is based around a Judas swing above liquidity before the real price move, and I usually anticipate that to happen during the morning, and then this bullish breaker was sort of something that I'd pull out for maybe the PM session if we didn't get the trade we were looking for. So I'm going to go through here and see if this would give us a setup that makes more sense. We've got buy side liquidity being taken here, we've got the market structure break through there, and once it comes above here, I think that's the break of structure. Entry is within a discount. However, in order to do that, we need to identify the breaker block, which is what this strategy is based on. So bullish breaker, there'll be a low, high, then a lower low. So I mean, we've got a bullish breaker here, haven't we? We've got a low, high, lower low. The last up leg in price is the bullish breaker, and it looks like that's already been utilized, hasn't it? Price has traded through the bullish breaker, it's come back into the mean threshold. So it looks like it's already kind of left that breaker there. So we're not really going to be using that. Besides, we'd probably be getting to the chart maybe just half an hour before 8:30, so we wouldn't be able to take trades back here. So we're gonna have to wait until we see a lower low to be our bullish breaker. Our Z price just keeps going up. So this is fine. We're just gonna wait to see if we get a bullish break, and if not, we're just gonna, you know, move to the sidelines and skip this day altogether. So that's definitely a price rally. This is definitely a large displacement here. So that kind of looks like the type of fair value gap that price might want to come back into, and so we'll keep an eye on that, but we're still looking for this. Okay, we're getting a lower low here, so that'll be useful. We've got a swing low here, a high, and then this looks like it's going to make a lower low. Let's do one more candle just to confirm that. Once we get the green candle, that can be our swing low. Okay, so we've got, well, we actually got a swing low here, swing low, high here, low, high, lower low. The last up leg in price, including the wicks, is our bullish breaker. We'll even mark out the midpoint as well. And we're going to be looking for an inversion fair value gap. With the idea being that the reason we want to use an inversion fair value gap is because if price kind of comes up here, creates some displacement, we might not really get in at a very good price. So by understanding an inversion fair value gap, all we need is for price to show a willingness to go above here to close. And another reason that daily bias is really useful is because if we zoom out, we can actually see those levels that we identified on the daily chart. And we came up with the bias that price over the next couple of days would be reaching for this level. We didn't really identify a level in between there, but you know, that definitely gives us, you know, some sort of rationale for price going higher. We're going to make this red to signify it as our inversion fair value gap. inversion fair value gap. We want to see price close above it, and then we also want it to be in a discount as well. And to do that, we're going to use the low and the high that form this pattern, and then this can sort of give us our sort of discount area. Okay, so let's see if price closes above the inversion fair value gap. Yep, that's closing above it. And then we want to enter, finally, we want the stop loss to be below the breaker, and we want to enter within the discount area. So let's go for a long position, put that as within the inversion fair value gap, as close to the being within the red here, the discount. Our maximum stop loss that we can use is 18 pips. So at minimum, we want it to be below, the stop loss has to be below this breaker here. And well, ideally we want it to at least be, I mean really we would want the stop loss here, or at the very least below this candle. So I'm going to utilize the maximum stop loss I can use here, because I can sort of imagine price making some pretty big movements. Then we'll use this standard deviation. And then in order to get filled, price has to come down here. So let's see if we get filled. Yep, price comes down. It makes a big move down, almost stops us out actually. Comes just below this this breaker here. So let's hope we don't get stopped out in the next candle, otherwise that will be frustrating. If we were still using the 12 pips, we would have been stopped out there. But the idea now is that we put in the stop loss at a place that invalidates the trade. And if price closes below the breaker, and if it closes below the last low, that's obviously the market structure shift low, that invalidates it. So that way we don't need to take the guesswork out of it. We just put the stop loss at the place that would invalidate the trade, and then we might have got freaked out here on this candle and regretted entering, but at this point we just have to, now it's out of our hands, the trade is active now, so we just have to let this play out. So it broke the market, the previous high there, so that's good to see. Just going to keep an eye out for failure to break a high. Okay, so it makes a retracement. Let's see if we can find a reason why it might be coming back down, and that looks like it's this, isn't it? We've got a fair value gap here. Just so we don't freak out and just exit the trade. This is sort of, it's reasonable that price is going to want to come back into here. In fact, this is also a pretty acceptable model as well. You have a fair value gap once price gets through the breaker. Then maybe you put, a long position in here. The stop loss has to be below the last swing low. So really, if we're going to be doing a later entry like this, we would need a larger stop loss. So let's pretend we hadn't entered here and we'd entered here instead. See what happens. Price comes down. Yeah, it likes to make that big push through, a big wick under. It goes back up again. Luckily this wick never closes below this swing low here, so that's fine. We didn't actually enter this trade here, so I'm just going to remove that. We're only looking at this. Whoopsie, I clicked the play button. Oh dear. Okay, I was going to go through it bit by bit, and obviously we're looking at this and being like, oh, we should have had the stop, we should have had the take profit all the way out here. This is where actually the trade invalidated would be useful. You kind of use this. You don't want to use this right at the very beginning because you need to let price. You need to give price a chance to see what it's going to do. Once we're heading towards our take profit, I guess we could just for fun use this. Failed to break old high. So let's just remember for a high we need a high to actually be made here, and then we need to see if price is going to come back up again. We do one more candle. Okay, that's a swing high here. Failed to get above there, so that'll be where we're moving the stop loss to break even. Now that that condition had been met, secondly we'll be looking to see if a down close candle gets violated with a close, and that's kind of disputable. I'm kind of going to go with this one because this was where the swing high happened here. So now we're saying, okay, this candle here, we're going to use that one there. See if price kind of closes below there. Okay, it makes a green candle as a wick. That's fine. Still didn't close below there. That's fine. Still hasn't been violated. Green candle. Another green goes up again. Looks like it's making a swing high here. So we can kind of reset this again and look to see if it fails to break an old high. That looks like a swing high, and that's a pretty big move down, isn't it? I don't know, let's just test it out. Let's just see if price makes another high here. Kind of looks like if it does make a swing high, it's going to be pretty difficult to break that there. So let's just see what happens. Okay, that's our swing high. Failed to break that swing high. So now we're back to stop loss to break even again. If this candle here violates this candle, which kind of looks like it is. Yep, okay, so there we go. Now we're going to move the take profit to the most recent high, which is here. Or if we wanted to be even better, we could even just say, okay, we've got a fair value gap here. Kind of makes sense that maybe price will come back into this fair value gap. We could do something like that. See if we move our take profit there, can we exit the trade there? If price leaves this fair value gap though, that's not what we want to see. And then finally, if that never happens, if we never get our take profit, we're then saying violates the mean threshold of the bullish breaker, or if it creates a market structure shift low, which actually happened here, didn't it? This was actually where it created a market structure shift low. So what we should have done is actually, once it did that, we should have kind of exited, or at least tried to get out here. But obviously this is all just me, hypothetical. Me just like, we didn't actually do this. We were just sort of testing these invalidated if statements. What actually happened is that we stuck to our ratio here, and we got out. Had a trade did not last that long at all. Maybe about sort of half an hour there. Half an hour as opposed to the next 2 hours sort of watching price come back up and down, and I'm sure if we'd stayed in this, price kind of keeps moving sort of sideways through the lunch session here, so would have been much better just to take, get this 84 pips within half an hour, walk away, maybe come back for the PM session, as opposed to sort of sitting here glued to the chart for the next 3 hours, which would be exhausting. So yeah, I think these trade invalidated ifs would sort of just be like a fail safe really, rather than a rather than just do that in every trade, because obviously it can kind of be a bit of a slippery slope there. It starts kind of coming down much more quickly than we expected. And I guess we'll have a quick look at what happens in the PM session. No, actually I think I'll save that for next, because I'm kind of used up most of my focus on this trade setup here. So we'll end this session, and let me know if you have any questions, and see you next time.